One of the best ways of investing passively and also enjoy diversification within real estate is investing in a private equity fund. Now, a private equity fund is essentially like a blind fund if you want to invest based on an investment philosophy or a business plan of the fund managers or sponsors and don't really want to do due diligence on deal-by-deal basis. Private equity funds are the way to go. Now, to understand how private equity funds work and if they are the right fit in your investment strategy, stay tuned. Let's first get this out of the way. What is a private equity fund and how does it work? A private equity fund is professionally managed pool of private capital, which involves acquisition, financing, ownership, either direct or indirect, of property or properties via an investment fund. Now, of course, a real estate private equity fund is something that acquires different type of real estate assets like multifamily, industrial, retail, office spaces, hotel, self-storage, etc. under commercial type, or a whole portfolio of single family, maybe under a residential type. Now, private equity funds are a very popular choice among a lot of investors who want to stay completely passive and want to have a professional manage their money, invest in equity without really having to own or manage a property themselves, help them diversify in different asset classes, and give them returns in exchange for a fee. Now, most of these investments are private investments and are not accessible to everyone. Private equity real estate investing is pretty risky, but it also provides high returns. Now, a private equity fund usually has a general partner that raises capital, finds the asset, adds value, operates and manages them for a fee and a share of upside. And then you have the limited partner or partners, which on the other hand are passive investors in the fund, and they are the main source for the capital. So private equity funds essentially are type of blind funds since the general partners typically raise money before putting an asset under contract. So they have an investment criteria based on which they raise the money from the limited partners, and then they go and find the asset that fits the criteria. So these criteria could be anything from geography to the asset type. Now, let's find out some of the pros and cons of investing in a real estate private equity fund. So what are some of the pros? Number one, better returns. Buying with professionals can take your portfolio to the next level with their expertise and their experience. So the sponsors of these funds really have a lot of knowledge and expertise in the asset types and the market the fund is targeting. So this gives an added advantage, which most likely produce higher returns than any kind of a generic investment or just randomly buying or selling stocks on public market without really understanding the fundamentals. Number two, diversification. Now, a private equity real estate fund can offer you diversity in terms of different asset types since it's a pool of capital investing in several assets and it can scale to multiple types of assets. Of course, as I mentioned earlier, every fund has their own investment criteria and philosophy, and the underlying asset is going to have to match this criteria before the general partner even considers to acquire them. So the risk diversity really helps losses from one property to offset the gains by other fund properties. Number three, choice. So as a passive investor, you have the power and the choice to choose the funds and their sponsors based on their investment philosophy and the criteria based on which they will be selecting assets and markets. So it is definitely not shooting in the dark and trading based on emotions. And of course, you have to do your own due diligence and background checks before you can trust your money with any fund. Number four, better price and terms. Now, funds are worthwhile for sponsors if they are bigger deals. Now, larger the deals, more the money invested, and it gives the general partners more negotiation power on behalf of their limited partners on the purchasing price and the terms with the seller. Number 5, scale. Now, unlike single-family houses or small properties, in funds, the investments are much larger commercial properties. So you can get advantages from interest-only loans, higher cash flow, better expense ratios, lower property management fees for larger properties. So your risk is really divided with all the investors who are pulling in the money, and all of the investors can enjoy the upside. Number 6, expertise. You're working with professionals who have years, if not decades, of experience. And each person on the team have their own expertise in the asset and the market. Number 7, tax benefits. Investing by a fund has a lot of tax benefits. You can also take advantage of bonus depreciation and cost segregation, which is depreciation on steroids. Now, more on cost segregation in another detailed video, but as an investor, you want your money not only to work incredibly hard, but also you want it in a tax-efficient way. So no one wants to pay more taxes than they have to. Cost saving from various tax benefits on underlying asset will eventually be passed on to the limited partners. Both income earned from the investment and the depreciation write-offs will be captured on an investor's K-1 come tax time. So do consult your tax professional to get tax advice based on your specific case. Now, what are some of the challenges of investing with a private equity fund? Number 1, liquidity. Most of the real estate private equity funds are long-term investments. They are longer commitments, and most of them are pretty illiquid. Unlike some of the REITs and public funds where you can just buy and sell them anytime you want on public market. Number 2, access. Access is also another con. Like, many of these funds have certain criteria to vet their investors before they can advertise their funds to them. Now, the criteria here could be based on income and or the net worth of an individual to qualify them as a limited partner in the fund. Also, there is usually a minimum investment requirement, which could be from higher 5 digits to 6 digits, which could deter a lot of new and small investors. Number 3, fees. Now, there are many fees like management fee, performance fee, acquisition fee, and all other types of fees, which could be very expensive if the fund is underperforming as compared to inexpensive alternatives like public stocks or ETFs. Number 4, control. If you are the type of investor who is hands-on and would like to get involved in every aspect of the operation of the asset on a daily basis, investing in fund is not a great fit for you. Now, usually a general partner gives the investors monthly or quarterly updates, but you are still a passive investor and you cannot get involved in any activities related to the fund or the underlying asset. Now, blind funds typically work on an investment philosophy, and they are not dealing from a project-to-project basis. So when you're investing capital, you're really relying on that investment philosophy and the track record of the general partners without really having much of visibility into the underlying asset that your money will be invested in. So it's like writing a blank check. So finally, the choice is yours. As a passive investor, it is your duty to do your due diligence on the fund and find out its historic performance, the credibility of the general partners, their track record, and their ability to deliver what they promised. Watch out for my next series of videos explaining the different ways of investing in real estate in detail.